Hello and welcome to this mid-year European Banking Outlook webinar brought to you by Scope Ratings. My name is Keith Mullin and it's my pleasure to be your moderator today. And I'm delighted to be joined by Marco Troiano and Alessandro Boratti from Scope's Financial Institutions Group. In a moment, Marco and Alessandro will take you through a presentation covering their expectations for European bank profitability and other key performance metrics. They'll also cover some broader banking themes, including European bank exposure to US tariffs and other US policies, and some perspectives on the current European bank M&A frenzy. Now, after the presentation, we'll move to Q&A, and we'll be delighted to take your questions. So please type these in as we go along, and we'll get to them later. Now, we do have some slides to accompany the presentation, but at the end of today's session, we're offering exclusive pre-publication download of Scope's mid-year European Banking Outlook, which, let me tell you, goes into a lot more detail than the webinar version, including a series of country-by-country snapshots and more detailed text narrative. I'll explain how to do that at the end. So that's it from me. Marco, Alessandro, great to see you as always. Let's jump straight in. Marco, I believe you're going to start. So let me hand over the floor to you.
Thank you, Keith. And good afternoon, everyone, and thanks for being with us this afternoon. Thank you, Keith, for organizing this webinar. I think timing happens to be great, given all the news flow that we have this week. It's ECB week. We have announcements around the M&A and noise around trade tariffs. So that's extremely well timed. Of course, by chance, we didn't know this would be happening this week, but that's the world we live in. Very fast changing, and this is exactly why we're having these mid-year updates for the last couple of years. With armed conflicts around Europe, to the south and to the east, and now a more unfriendly ally across the ocean. We think it's important to keep the market updated on our views and how we think these developments will affect European banks. So I would say one thing I would like to mention is that, of course, we do these webinars periodically, but our day-to-day work, we have a lot of publications, we publish research, we publish ratings, so you can stay up to date on our views there. One thing I'd like to highlight is that the way we work is trying to structurally filter out noise and actually try to gather signals from what we see around us. We are bombarded with high-frequency data releases and information, but in the end, we're credit analysts, we're a credit agency, so we need to isolate fundamental long-term trends that can, at the end, impact the credit risk of the issuers we rate. And we actually make it, we're quite proud, and we make it an analytical USP that our ratings are especially stable through the cycle by design, through long-term rating anchoring, look-through approaches, and compare and contrast analysis. Let me give you an overview of our rating activity in the first half of the year. We've added 14 new ratings to our coverage, some public, some private. I want to highlight in particular our public rating on Alpha Bank, which was the first Greek systemic bank to mandate Scope Ratings. We've also had almost 50 rating reviews on European banks. Now, more than 4/5 of these have resulted in rating affirmations, which is consistent with the overall outlook that we had presented at the beginning of the year. There are some exceptions, but these are not really driven by financial trends, rather by very specific idiosyncratic situations at the issuers. For example, transformative corporate operations. The latest one is the upgrade of Banca Popolare di Sondrio last week, following the acquisition or the completion of the exchange offer from BPER, and reflecting our expectation that as the bank will be integrated into BPER, it will be part of a stronger group and therefore a better credit risk. We've also this year upgraded our operating environment assessment on Portugal and on the Netherlands, which has resulted in some rating upgrades. Now, as you know, several of our ratings are not in the public domain, but are subscription only. So I cannot share that with you, but if you'd like to get access, just get in touch with us and with our markets team, and you might get access to our subscription platform. We've also published an operating environment booklet, which highlights and details the drivers behind these upgrades in the operating environment for Dutch banks and Portuguese banks. And finally, we publish research almost on a weekly basis on major countries in Europe, so the UK, Spain, Italy, France. We also publish topical research and shorter commentaries. So if you're not signed up, please sign up to our research to stay up to date on our latest views. So moving on to the next slide, I'm going to give you a quick overview of what we're going to go over today, which actually I'm going to leave to Alessandro to go into more details. So we're going to have a brief look at the macro environment and specifically how the current environment is affecting the outlook for European banks, including the high uncertainty around tariffs, geopolitical risks, and also interest rate expectations and others changing. We look at how this affects profitability, and spoiler alert, you'll see that actually things are going better than we were anticipating at the beginning of the year, but Alessandro will go into more detail. We look at asset quality, look at the latest trends and what we're seeing in the data so far. We're looking at capital, how capital ratios are moving against the backdrop of very high distribution, but very profitable banks, and including the first time implementation of the final Basel III or CRR3 in Europe. We had the first few data points on Q1 releases. Then, of course, we do need to discuss bank consolidation and M&A. This remains a very hot topic for anyone looking at the sector. There's a lot going on, a lot of announcements, both domestic and cross borders, a lot of political meddling into the sector, which we actually think is looking for answers. And we believe we're at a crucial junction where some of these key questions will have to be cleared over the course of the coming months. And then, of course, we're going to have the opportunity for you to ask any questions that we don't cover in this presentation. So this is, we want to make these webinars as interactive as possible. So if you have questions or topics, please shoot them in the chat box, as Keith said, and we'll do our best to answer the ones that we can answer, and the ones we can't answer, we'll take them with us for further research. With that, Alessandro, I'll hand over to you to go over the key themes, and I'll shut myself up.
Thank you, Marco, and good afternoon to everybody. So what we did now in July was rerunning our forecast on the top 40 largest banks in our rated coverage. And I'm going to present to you the key results, and these supported by some set of data that give us a bit of an overview of what's going on in the market. So we start from profitability and from net interest income, looking first at margins. Now, if we look at the chart on the left-hand side, you see that on the lending side, so on commercial loan spreads, margins have started to shrink across the block. Of course, there are countries where this has started a bit earlier, countries where actually hasn't started yet, like in France. This is due to differences in the sector's characteristics, as well as in banks' balance sheets structures. You have banks where assets reprice faster than liabilities, and places like in France, where there is like the products like the Livret A, where liabilities have repriced very fast in the past years, and now assets are catching up. Our view on margins hasn't really changed over the past 6 months. We have seen central banks cutting rates across Europe. And this was more or less in line with what we expected and banks themselves expected. So we still stick to our central scenario, central base case that net interest margins will decline over time, starting from this year and the next 2 years. It's true, though, that while we see a reduction in the loan spread, banks are doing a lot to counteract these effects. So starting with hedgings, they are investing in debt securities, so building up ALCO's portfolios to support net interest income. So all in all, the decline we are observing is quite contained all in all. And on the positive side, we have tailwinds from the loan side. So lending has rebounded over the past few months, mostly on the back of lower rates. So borrowing has become, or at least it is, let's say, less costly than it was in 2023 and 2024 particularly. So this has, of course, triggered an increase in demand, particularly in mortgages. But we are also seeing an increase in the loans to non-financial corporations, as the companies need to refinance the debt that was taken out during the COVID pandemic. So all in all, the effect is still negative, which means that on net interest income we see a negative. So we see the margin effect being larger than the loan volume effect. That being said, on the other side, we have the components, the non-interest component that are growing, particularly fees from sales of wealth management products, asset management products, distribution of insurance products. We have investment. We are observing investment banking turnover being quite strong, particularly in capital markets. And so all these support revenue. So in our base case, revenues will slightly decline in 2025 before growing again in 2026 and 2027, with the fee component taking over, let's say, so pulling revenues up. That being said, on the right-hand side, we've taken we wanted to show some data on costs. This is taken from DCB Spring Financial Stability Review report. I think it was quite interesting to show you the dynamics of costs over the past few years and how cost growth has declined on a overall from an overall point of view, mostly driven by the contribution to deposit to guarantee schemes and resolution funds that have decreased and are expected to decrease further. Actually, on the core component, you see an increase in the contribution from wages and also from all the costs related to investments in IT. We see the pressure on wages fading slowly across the block over the coming years, but we actually see more pressure instead from the investments in IT. So all in all, we see cost growth being at around 1% in 2025 and being at around 2 to 3% in 2026 and 2027. So all in all, a cost to income which will remain stable in 2025 and be slightly worse in 2026 and 2027. Now, looking at provisions, you see here on the left-hand side that we have worsened just slightly our forecast for cost of risk. Now, this incorporates just a macroeconomic outlook which is more uncertain. Of course, the trade war, the geopolitical risks are of course are looming over the banks and the macroeconomic outlook. So we see some worsening of cost of risk, not really related to a deterioration, actual deterioration in asset quality, but rather by the fact that just because there is more uncertainty, banks need to provision more, and so we'll see an uptick in cost of risk, a higher uptick than previously expected. We are still looking at 30 basis points median across our sample of 40 banks. So it's a level which is still well under control across our coverage. On the right-hand side, you can see the comfort we have with banks across the whole coverage. You see the difference between the pre-provision profitability and the cost of risk, and the buffer is very large in some cases, but overall they are quite comfortable everywhere. And so this actually also underpins the fact that we have mostly stable outlooks on our coverage. Last, on profitability, an overview of results and our view for profitability going forward. We have seen that in Q1 actually profits kept growing. So of course the growth has lost some steam over the past few quarters, but still is still growing. We see some banks like this morning UniCredit reporting still some growth. So there are banks actually reporting very strong results. We didn't expect that back in January. So we have upgraded our forecasts for the next, actually for the next 2 years. So both in 2025 and 2026, we see an ROE in the double-digit area for both years, whereas we are a bit more cautious in 2027. Now, a look at asset quality. Of course, I suspect this is a very interesting topic for many. Now, we have looked at what would be the impact of the US tariffs on banks' asset quality. The key message that we want to give you today is that we don't expect a massive or even a material at all impact of US tariffs on the bank's asset quality. The reasons for that are plenty. First of all, because there is no such combination of banks geared towards corporate lending and countries that are highly exposed to the US. Second, because banks have highly diversified lending books. So there's no really, among at least the larger banks, there are no cases where a bank is highly exposed to a certain sector, like could be automotive, could be pharmaceutical sector, that are the most exposed to potential US tariffs. So the direct impacts should be moderate, if negligible. Of course, the effects that needs to be looked at and watch out for are the second round effects, so the potential impacts on the economic growth, which in turn may then have may crystallize in some asset quality problems. But if we look at the EBA risk assessment questionnaire and the data in there, we see that actually banks have gotten more positive about the next 12 months in terms of deterioration in asset quality. So the percentage of respondents that expect a deterioration in asset quality has shrunk, particularly in the residential mortgages. The main driver for this is the reduction in the borrowing costs. So of course this eases the debt burden particularly in the residential segment, but also across the board. There's still some deterioration expected in the SME segment and in the commercial real estate, but all in all, banks are quite positive, and we agree with lenders. We think that, of course, a deterioration is to be expected, but we start from a very low base. So I wouldn't see a new asset quality cycle, rather an uptick in cost of risk, some pockets of deterioration, but overall on the headline asset quality, for the time being, we don't see, let's say, a tsunami of going against us. A word on capital as well. What we saw in Q4 and then also in the Q1 2025 is a reversal of trend, if you will. We had a plateau in the capital buffers from mid 2022 to end of 2024, with the capital buffer at around 4%. Now we see this trending lower. The reasons for that were the first time implementation of Basel III rules and as well the distribution for 2024 results. We need to see if this trend crystallizes, and we'll see a lower buffers going forward. Of course, requirements are also growing across our coverage due to systemic risk buffers increasing, to countercyclical buffers increasing. So we could see some decline. Of course, there is also M&A activity which may have an impact, but overall the current capitalization remains strong across the board. And on the right-hand side, you see the increase in distribution. Of course, it reflects the improvement in profitability. Last but not least, on the bank's fundamentals, we have a slide on funding and liquidity. Here, the quick message I want to give to you is the fact that deposits are back to growth across Europe. Of course, there are countries where growth is stronger. For instance, I think about Netherlands, Greece. Sometimes, of course, it's also driven by the lending growth. Sometimes not. But the key consequence, let's say, is that refinancing needs remain quite subdued. And also after the phase out of TLTRO3, the needs for more issuance of debt has reduced. You see the growth in the bonds portfolio actually declining in 2025. We expect still positive net issuance going forward, but this won't be as big, as large as growth as in the past 2 years. Now, I'd like to finish my presentation by looking at 2 themes we have identified being, let's say, more interesting for you. One is, of course, M&A. I think the chart speaks for itself. You have the value of M&A deals over the past 9 years, and you see the spike in 2024. And actually, this is year-to-date data for 2025. So I would suspect that for 2025, we'll see even a larger number. Now, the growth in transactions, also in value, but also in both in number and value, in our opinion, was driven by banks looking for new legs of value creation now that interest rates have declined. We know that several banks have seen their market multiples increasing a lot over the past year. So they used this strong position to make acquisitions, to make bids. And we have seen that these bids have actually most of the time consisted in a share exchange, so no cash involved, which is quite interesting. Of course, then the capital hit is significantly lower. We reiterate here that we see more value and more rational for domestic deals because synergies are more obvious. You have cost synergies, the possibility perhaps to streamline the branch network, reconsider the number of employees, merge functions, etc. You have the possibility to consolidate market share, enter new segments within the same market. Whereas on the cross-border side, yes, there have been a couple of transactions, but these were quite small for both the cases. I'm thinking about BPC, for instance, in Portugal. The room for large cross-border transactions is smaller in our view, and the reason for that is basically what we have been saying for years. The European Banking Union is not completed. Revenues are less obvious, more difficult to extract. There's no fungibility in funding, so there are more obstacles, and for this reason, we see going forward more domestic deals than cross-border ones. And to finish, a look, as Marco anticipated before, a look at the Q1 data. First time banks report this data on Basel III output floor. Now, what you see on the slide is the capital buffer as of Q1 2025, and the theoretical 2033 impact from the full application of the Basel III output floor, assuming static balance sheet and no mitigation. The main takeaway here is that for most of banks, this is really not a topic. So there's no impact expected at all. Some banks will, as of today, would manage the impact using excess capital. Yes, there are a couple of cases where this can be a constraint, but of course there are there's lots of time to prepare for this, for the phasing of the rules. Possibility to of course rework the exposure, as well as the possibility to rethink about dividend distribution. So I think all in all, we are quite comfortable on the data we see here, and this is a positive for European banks. So I'll stop it here, and I think we can start with the Q&A.
Very good. I think we're just both trying to adjust the slides at the same time. Thank you so much for your comments, Alessandro and Marco. So look, let's move to Q&A. I've got a few lined up, but I might prefer to ask audience questions. Okay, we'll go straight in with an audience question, Marco and Alessandro, which is this: do you think the mergers in the banking sector are as welcome in large EU countries as they are in very small countries like Cyprus? Are there dangers involved in market consolidation when the market is small, such as Cyprus? Interesting question. Anyone? Do you want to take that one?
Maybe I'll take Keith. Thank you. So I think it's a good question. We have a lot of noise around M&A deals in large countries. In particular, we're seeing political ostracism for large deals in Germany, Italy, and Spain, where the governments have generally been quite vocally opposed to consolidation deals. We find that this is less the case in smaller countries. And this is one of the elements I mentioned before, one of the key questions which I expect to be cleared out this year. We know that there are legal proceedings ongoing in Italy for sure, and we know that there are discussions between national governments and European commissions around the legitimacy of national governments putting hurdles to M&A. And this would, of course, primarily refers to domestic deals, but we could extrapolate any result from this debate also to some cross-border operations, which perhaps have not been launched for lack of support from the government as a key stakeholder, such as the UniCredit Commerzbank case. So back to your question, Maria, is for sure there is a higher hurdle, and there seems to be quite a residual of banking nationalism for the large countries. Everyone seems to be very happy when it's banks from their countries going out and buying competitors in other countries, not so much when national banks are the target of cross-border consolidations. And in many cases, banking is seen as a key asset. It was a case, for example, in Italy, where golden power rules were activated. But at the same time, we live in a single market now for several decades, and I think this is very important that we get some clarity on, whether effectively the European banking market integration can progress and move forward, or whether we're seeing further fragmentation along national lines again.
Okay, thanks. Now, there is a question. I'll mention it in passing. There's a question, a very specific question about Nordea. And to our questioner, we're going to skip that one, if you don't mind, on this session, but we will circle back to you after the session with some feedback on that specific topic. So I hope that's okay. Look, Alessandro, your presentation was very insightful, and I think you covered all the high points and the key points. But I guess one of the issues that comes out of talking in a sort of aggregate context, you said you were focusing on the sort of top 40 banks in the coverage, is that by definition it suggests that the performance will be homogeneous over the next 18 months or so, because you referenced next year in 2027. In that sort of context, are there some banks that are expected to do better than others?
I'd say that yes, of course. There are. I think I would split the answer in two parts. So first, talking about bank's business model, and then talking about some specific geographies. We have said, I think, multiple times that in a scenario of lower interest rates, we see banks that are highly diversified, with stronger franchises in asset management, in bank assurance, or investment banking, doing better than banks with a more plain vanilla commercial lending franchise. So we see the more diversified banks doing better, or relatively better, in a scenario of lower interest rates. It was the case before the pandemic. We see this as well going forward. It doesn't surprise that actually banks are working a lot on their business model at diversification across Europe. Of course, I'm a lead analyst on Italian banks, so I see this particularly in Italy, but this is also a widespread approach, strategic approach as of today. Second, in terms of countries, we've seen, I've mentioned it briefly in my presentation, that we see, so for French banks, there is still some upside, but starting from a low base. And partly this reflects actually the fact that when we talk about French banks, the larger are highly diversified, so they are going to be better in this scenario. But also because in France, retail banking margins in retail banking are easing now. They are increasing, I should say. So we see French banks doing relatively better, and profitability actually increasing for French banks, whereas somewhere else it will slightly decline. And on the opposite spectrum, we've looked at Swedish banks' profitability, and I should say results over the past week, and they have shown a more than expected decline in margins and net interest income. So there is some pressure, but again, the opposite of French banks, they start from a very high base, so they will remain highly profitable. So yes, the answer is yes. There are different trends across Europe, but all in all banks are doing quite well.
Yeah. Okay. Good. Thanks for that. Marco, this M&A topic is it's fascinating this year and last year, and you've been very consistent throughout this M&A cycle. And you already mentioned that domestic deals have a perhaps better rationale than cross-border ones, but we have seen some divergence from that. And I think Alessandro mentioned BPC bidding for Novo Banco in Portugal, and Erste Group Bank entering Poland. How do you see those developments within your sort of overall M&A context?
Look, I stick to my long-held view that I think there is a sound rationale for consolidation within domestic markets. I think that the economic case for cross-border is a lot more difficult. So in domestic deals, you get all the cost synergies from branch overlap, branch optimization. You get easier, central synergies from actually getting to merge the acquired entity, and You might get revenue synergies from essentially cross-selling of products. All of that is a lot more difficult in a cross-border deal, not least because the European Banking Union, has made a lot of progress, but it's far from complete. We still have separate deposit insurance schemes in the different countries, which sort of complicate the economics of merging banking entities. You do have regulatory requirements which are still applied both at consolidated and individual bank entity level, especially for cross-border groups. So I think the reality is that cross-border synergies, such as, for example, using cheap funding from one country to finance loan book in another country, are very difficult to fully materialize. So I generally stick to my view that domestic is a lot easier. Now, I'm actually quite happy to see that there are a handful of very courageous bankers that are happy to look beyond the near-term challenges and take a look-through approach. Imagine how the world will look in 10 years, perhaps, with a more unified Europe and a more advanced banking union, and start pre-positioning their groups for essentially being those pan-European champions that everyone likes to talk about, but no one really likes to favor when it comes to approving foreign buyers of domestic banks. So I think it's a good development. The interests of UniCredit in Germany, the interests of BPC in Portugal or in Germany, French banks in general are growing in Germany, or Erste entering Poland. I think it's a sort of a very long-sighted pre-positioning of the group, of the groups, to eventually become platform for growth and becoming these pan-European banking groups. Just remember that when you look at the global scene, European banks are nowhere to be seen. All of the largest banks are US-based, China-based, and that's a huge difference from what we used to see 20 years ago, before the GFC. So we need to ask the questions: are European banks ever going to be competitive on a global scale, meaning especially on ultra large corporates and markets and investment banking and other scale businesses? The only way to have that is to look at Europe as a single market. If we stick to national champions, we're condemned to have a second league banking system when we look at these global businesses. So I see it quite positively. I still think the economics of these deals are difficult if you look really short term, but it shows that the management teams are happy to take a very strategic approach.
Yeah, absolutely, it makes sense. Now, I'll stick with you, Marco, on this M&A topic just for a second. So Alessandro showed that slide showing the spike in M&A last year, this year, and was quite clear that the 25 bar is year to date, with the expectation of more deals announced in the near future. Now, I won't ask you to speculate on who might bid for whom. That would not be appropriate for a credit rating agency. But more broadly, do you expect more deals to be announced in the near future? And just could perhaps give some reaction to that question.
Yes, I think this is actually a trend, a mega trend that will stay with us for a few years, and for two reasons. One is, as Alessandro mentioned, banks have seen an extremely positive cycle thanks to the interest rate environment. They've been making good money, but that value lever is over. And I think if you're a bank manager now watching your share price, you need to find new ways to keep earnings growth and share price growth happening. And then part of that is actually looking for synergies through consolidation. The other one is that there is excess capital in the sector that, yes, can be returned to shareholders through dividend and buybacks, but not always. We also have non-listed entities in Europe, cooperative groups, and these groups are accumulating capital at a very fast pace. I think it's not a surprise that actually some of the French mutualist groups are expanding through cash finance deals. And then, just a more general reasoning that I've been making over recent years actually is that I think banking is becoming more of a scale business than it was in the past. With the need to digitalize, the need to invest in technology over the last year, with the rise of artificial intelligence, I think the importance of scale has grown, both for the ability of banks to invest in this technology, so to deploy bigger budgets that can then bear fruits across a large organization, but also in terms of gathering more data, which I think is an overlooked aspect of it. The more and better data you have, the better you can train your algorithms, including your credit algorithms and everything else. And I think that's a competitive advantage. So I think that's a serious challenge for smaller sized banks that they need to address. And part of this will come through consolidation of second tier, third tier banks in Europe. One possibility is also that they manage that through consortia and alliances. But I think that's going to be a driver for quite some time.
Yeah. Excellent. Thank you for that. We have a question about banks in Central and Eastern Europe. Alessandro, if I may, I'll put that one to you. And the question is a quite simple one, which is what explains the much larger ROE in CEE banks compared to Eurozone banks, and perhaps any view on the outlook. Can you take that one?
Yes, so I would say growth. It's an easy answer probably. So we see, well, we have our view. We have in our rated coverage OTP. So we can refer to that bank, but of course we also look at other banks in the CE area. And yeah, I mean the key difference between markets that are still developing rather than the mature ones is that growth is much higher. The penetration of banking products is much lower, so there is really much of a gap to grow in various segments, and this of course generates lots of revenues for banks and growth. So this is one of the main driver. The second one is also margins. Margins are larger than in the more mature market in Europe, especially in the in countries in the more Eastern Europe countries, Southeastern Europe countries. So margins and growth, it's what drives profitability, and we are in a positive cycle. So you would expect asset quality to be worse, significantly worse in the CE area. That's not really the case as of today, where we see actually asset quality doing very well and cost of risk quite under control for CE banks. And so of course that also supports this very strong profitability as of today.
Yeah, okay, absolutely makes sense. Thank you. I've got a question about, there's a kind of more of a regulatory question. Perhaps I'll put this to you, Michael. So look, we're at Basel III finalization, but there's a long kind of timeline here going out to 2033, I think, for credit risk in Europe. At the same time, you've got other jurisdictions maybe postponing implementation of various aspects. I mean, last week we had the Bank of England proposing to postpone the FRTB internal model approach to 2028. And there's a possibility that the US could ease capital requirements. So the question, how would that affect European banks? And I guess an allied question, have we seen peak regulation? And do you expect or foresee a period of deregulation? So it's been a long question, and forgive me, but a big topic.
I'm trying to break it up in my mind. So let's start from the easy ones. I do think we've reached peak regulation. The way I think about it is, regulation and risk taking in the financial sector goes in very long cycles. This cycle of re-regulation of the sector started with the GFC, of course, a big, crisis memory for the politicians, new rules being drafted and implemented. Now we're in 2025, almost 20 years later. There hasn't been any major banking crisis. I'm talking specifically about the European Banking Union. And I think regulatory fatigue is something to set in. And of course, there is always a trade-off between the safety of the sector and the near-term ability to finance growth, and that's what's very close to the heart of politicians who don't have a long crisis memory. So I do think that the pressures are building, including from the industry, in terms of more lobbying for surely for not introducing new rules. One element that this new implementation of rules has coincided in Europe with a very long period of financial repression, where banks have been particularly badly treated by the policy mix with super low interest rates, and bank shareholders haven't done great. Now they're doing okay, but I think they're essentially not prepared to see more of the capital generation being locked up in the safety valve of the sector, which is capital. So I do think we've reached peak. And I do see, for sure in the US, a strong push to start looking back at regulation. Frankly, I don't think in Europe we will see a wave of deregulation. So, we might react more slowly, and that's because Europe has a very peculiar setup when it comes to money creation and distribution, with a single central bank, and then the banking sector tasked to distribute money, or to transmit monetary policy, as the monetary economists like to say. And I think the downside or the consequences of this monetary transmission mechanism becoming impaired are a lot more severe in Europe than they are elsewhere, because you cannot, essentially you rely on the banks to have credit flowing a lot more than in other places. So I think that the bar will be very high to deregulate in Europe, and I'm glad that's the case, because as a rating agency, we do like prudential regulations which are quite tight. Now the reverse of the medal is that if the rest of the world moves towards deregulation, that will leave Europe at a competitive disadvantage in terms of capital intensity and capital absorption of some businesses compared to US peers in particular. So that would again go against the ability of European banks to play on the global field. I think what's interesting is to note that there, for example, I don't think that there is anyone talking about deregulation in Switzerland particularly, right? You've had a severe banking crisis a couple of years ago, and in fact, the country is going, including the politicians, so the parliament is going in the opposite direction, actually looking at where prudential regulation can be further strengthened to reduce risk, to the point of actually imposing on their only too big to fail bank additional capital requirements to the tune of whatever, 20, 30 billion. I don't have it on the top of my mind. So I think that's a little bit the way I look at it. I don't know if I've left out any element of the question.
No, that covers it. Yeah, thank you. I'm just conscious of our time here, that I did want to ask, perhaps back to you, Alessandro, about asset quality, which is perhaps one of the things that gets a lot of attention by bank watchers, investors, etc. Now, you talked about asset quality again in a sort of aggregated context, and I think your perspective is fairly benign, that you might see some deterioration overall, but not to the point where you're particularly concerned. But are there countries or sectors that are performing worse than others that we should perhaps be aware of?
I would say not really. We have seen over the past couple of years that there's been some deterioration in Germany and in Austria due to the commercial real estate. Sometimes commercial real estate, not actually in Europe, but in the US, when German banks are concerned. In reality, across Europe, what we've been observing is a convergence in NPL ratios. We have seen the peripheral banks cleaning up their balance sheets, and with default rates at record lows, there's no upward pressure on NPL ratios, so there is a convergence across Europe. Now, with the decline in first in inflation and then in interest rates, I would say that also pressure on commercial real estate itself has mitigated. There could still be some pockets, some single names going sour, but all in all, I would say that the picture is quite reassuring. So to conclude, we remain quite optimistic going forward. Of course, we continue monitor. We look at data not only top down, but also not only bottom up, I should say, but also top down. And let's see if anything deteriorates from here.
Let's do that. On that note, let me close the session formally. Thank you, Marco and Alessandro, for your insightful presentation responses. Thanks particularly to our viewers and for those who asked questions. There was a question about Cypriot banks, which we're going to again not cover this on the session, but we'll perhaps circle back just to reference. We have seen the question, but we'll get back to you on that. Look, these, as Marco said at the very beginning, there's a lot of moving targets, a lot of moving parts, a lot of components around European banking, and so we obviously will keep watching and commenting on developments, and as appropriate, we may at some point sooner or later come back and do an update session if that's required. I did say at the beginning that you would get exclusive download privileges for our as yet to be published banking outlook. So if the technology gods are on my side and our colleague Arwen in the background is listening in, there we go. Download now. There you go. As I say, there's all the slides that were in the presentation today are in there, but there's a hell of a lot more, including, I believe, half a dozen European banking snapshots. So do download that. We should be back soon, before too long. Marco mentioned at the beginning, we do publish research. So we do regular quarterlies on key European banking sectors. Bank Capital Quarterly, I think, is coming up quite soon, which looks at the capital regulations and perhaps other market issues affecting bank capital. And we have an NPL publication also on the launch pad, so look out for those. And we will see you next time. So be careful out there, enjoy the rest of the afternoon, and we'll see you soon.